right? When you're looking at the threat of tariffs, you'd think, okay, if we're going to make people look at things through a fundamental lens, this is it.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots, and I am joined as always by the Brain Trust himself, Mr. Chase Taylor. Maybe trying to sum this up in my mind even before I say it. Bounce back, really strong, kind of what you'd expect in the early part of the day, based off a lot of things that didn't seem.
So yeah, the fun part was that yesterday we got a Bassett bump for something he said, and then today he's the one that poured cold water on the initial bump from the day. So
yeah, a lot of nonsense, and it looks to me, especially when you see. I mean, obviously, it's a lot of the stocks have been hit the hardest, which makes sense. But boy, there's still that retail knee jerk reaction. We were talking before we came on, and I know we've talked, especially I've talked about valuation a lot, but it just, I feel like it's hard to explain to somebody that doesn't do this every single day. First of all, if they don't do this every single day, they probably have more hair and they're far less neurotic than you and I are. So more power to them. But even on a day like today, you'll see different names moving, right? And not different businesses, names that are businesses that are relatively very close, very similar. You call them competitors, right? And you look at the price movements on the two names, and then you look at the valuations, and naturally you sit there and you go to yourself, okay, clearly this thing must be growing a lot faster, right? Or must be a much more high, maybe it's more of an asset light business model. It's got clear advantages, right? Then you look under the hood and that's not at all the case. It's more expensive because more people want it, because it's been memeified or it's gotten caught up in the passive flow, whatever it is. But it's still amazing to sit there and go look at the underlying fundamentals and go, and it's not just one snapshot. We've seen it over and over and over, where it really leaves you, for instance, and I've harped on this one a lot of times, Costco comes to mind. You want to pay 60 times earnings for a retailer growing at 7% that has 2.75% margins? Why?
Yeah.
Why do you want that?
Size has been a very important factor. You can basically break the whole thing down by deciles and it keeps working.
Yep.
So it's obvious that size has mattered in the last few years.
Yeah. It's that the old adage, size doesn't matter. They weren't talking about stocks. The funny thing is it cuts against all market tradition. And it should.
Yeah, small caps used to be the way to go back in the day.
Small cap value since inception has averaged 15.5% a year, while the S&P average is 11.5%, right?
Now it can't get out of bed.
Right. And I think part of that isn't just market inefficiency. I think so many of those small cap companies now have stayed private and then have become unicorns and rolled out and done IPOs and things like that. So that's a big part of it. But another part of it you just can't ignore is the passive flows. My whole point, though, is that we could end up being proven wrong. But I think the gyrations or the I think if you look at the markets over the last 15 years, I think it was a perfect storm. Right. You had all these things come together, and I don't think all of them have to leave to stop it. I only think one or two have to leave. And I think that they have. I don't think it's going to work the same way going forward. And it isn't so far. But it's just remarkable. Like when for instance, you're looking at this whole tariff scenario, and in my mind, foolishly, I believe, okay, this is going to get people. Right. When you're looking at the threat of tariffs, you'd think, okay, if we're going to make people look at things through a fundamental lens, this is it. Right. Which ones are going to be hit by the tariffs worse? Not right. Which ones are going to be hit by the tariffs worse? Not still. No one cares.
I mean, I do think if you construct the tariff baskets and like Goldman Sachs did, who gets hit by them, who doesn't, like that has performed in a way that you would expect. So I think that's legit. It's just And hey, we've been critical of the market for not, you'll hear people say, oh, like a bunch of bad stuff's priced in. You're like, sure, like bad headlines for the last 2 months are priced in, but is like a recession priced in? Not at all. And it still isn't. But at the same time, like the market collectively looks at, the constraints facing the president on all these tariffs and goes, yeah, you're not gonna be able to do that. So we're just going to discount it as you're not doing that. And here we are, a month in past Liberation Day, and the president's backing down from doing most of it. So, or at least potentially looking that way.
Yeah.
So from that standpoint, maybe the people that were like, yeah, I'm just not going to price in a big recession because, all it takes is something like Walmart coming to the White House and be like, hey, guess what? Prices are going up and our shelves are going to be empty. Just want to let you know.
Yeah.
To get, policymakers to go, hey, how about we change our plan?
Yeah. Yeah. I don't know. I'm with you as it results. I guess my point would have been, I really thought, and I believe the process has started and these things don't play out over, especially we were talking about this the other day, right? I would expect this market phase to be probably the longest and most frustrating path back to normal.
Yeah.
In terms of market functioning, just because you have record levels of players, record lever, you got just all the financial weapons of mass destruction have been unleashed. All these different factors that we've talked. I just think this market's going to take an extraordinarily long time from a historical standpoint to sober up. The point I was making is I thought it was going to make people look at things in a more fundamental lens, right? Because you're right. The things that were most impacted by tariffs did get hit the hardest, right? But I look at an Apple still trading where it is.
Yeah, that's the one that always just stands out to me.
Yeah, you're just like, you're guys, their numbers weren't good coming into this. Okay, certainly not deserving of the multiple expansion they've seen over the last 2 years. I mean, it's a joke, literally, while their results have gone the other way on all levels, right? And it's not doing that.
And the two-sided China risk.
Yeah.
Moving production to India and Brazil.
Loss of market share.
Probably isn't cheap.
No, a loss of market share, sales down year over year on iPhones, which, look, if you're looking at Apple, you can talk about this. Dan Ives can go on and on about Apple and all of its. At the end of the day, Apple is the iPhone. That's it. That's it.
It's pretty tough to argue with you.
Yeah. I mean, it's what does it make up? 85% of its revenue? Probably something like that.
Past 70, it doesn't matter, right?
Yeah. Past 70 doesn't matter. Yeah. I mean, truthfully, past 50, it doesn't really matter. But yeah, it really is a remarkable time. Yesterday we talked about Philip Morris trading at 7 times sales. I've just never seen an environment last so long. And still, you listen to Kramer or the market, so many of the market people or prognosticators, there's still no fun. You won't hear a bit of fundamental analysis at anybody.
No, to be fair, investors aren't doing it. Like real investors aren't doing it either.
No, I know.
Yeah, a lot of them.
Yeah. So. And it just, hey, more power to you, because for the last decade, that has been the key, right? For a variety of different reasons. I just see absolutely no evidence of that being the case now. And funny enough, I actually think names like Philip Morris are the telltale sign, right? Because now you're talking about cigarettes, you're talking about vapes. Okay, you can't sell me on the whole exceptionalism of American corporations as it relates to tobacco inhalation, right? Like, Come on, save me the nonsense. But what I think what it does illustrate is how there is just an unreasonable premium on U.S. securities that just don't make any sense.
Yeah, and has been, we've seen it come in some so far this year.
Yep.
But where we go from here is going to be, and to me, like the last week, a lot has changed, and it's really muddied the waters. And I think that what I plan to write about this weekend is kind of this confluence of that I'm about to describe, because I think this is like the important like crossroads we're at. There's 2 camps. I don't know which one's right. Really struggling with this, and that is so I've been talking all year about the 2 things that matter most are the budget deficit and the trade deficit. If those both went down, markets were screwed. Now it's pretty clear to me that those are going down a lot less than it looked like a month ago, both. And that is way better for the U.S., not only economy, but markets. So that makes me want to be, way less bearish than I was a month ago. However, you also have this camp of people that have this like, yeah, but like we threw sand in Europe's face and they're taking their money home and like all this stuff that like, even if we take the tariffs back, a lot of stuff isn't coming back, right? I'm somewhere between those two. I don't know how right that is. I don't know, like, if 6 months from now we've played nice with everybody, are we really seeing everyone keep repatriating all their capital, or is it, if our assets do well enough for 6 months, is everyone like, oh yeah, that trade that worked for 15 years, let's get back in that? I truly feel directionless in that debate on where that goes. Not to mention, have we already created enough damage to have enough of a slowdown the rest of the year that it's felt in the market? So kind of there's three different ways of three-sided thing, and with the ongoing changes and the fact that we have no idea where these tariffs actually level out at, like I just find all of that difficult. But those are the questions I think that matter for assets the rest of the year.
It's funny you bring that up because you and I hadn't talked about that, and it's not unusual that this happens to you and I, but we both keyed on exactly the same thing. I was reading an article about this, and I've got I'm not sure either. I've got a little bit different take. But this one part of it that I'm going to bring up seems rather easy. I was reading, it was either a tweet or the headline of an article. I can't remember what, but it was along the lines of, why would any of, it's all done. It's all scorched earth at this point. Why would anybody trust this administration or this country? And I laughed out loud when I read it. And my answer to that person would have been, because we're the biggest consumer base in the world. Like, meaning, look, you're forgetting the other part. To me, it's like reverse home bias, right? Like, you're sitting there. I understand what you're saying. And I understand how belligerent the actions of the Trump administration could look to foreigners and all that kind of stuff. Okay, so here's why they'll trust us. Because they have to. They have to. Economically. What happens to your economy domestically if you have permanent, significant tariffs with the U.S. and you no longer have a cooperative? You're going to get shelled. There's just no way around it. So unless you want to lose an election, you're going to figure out a trade deal. And I'm not saying that that's how we should make policy. I'm not saying that doing trade deals like that can't come back to bite you.
Right.
Not saying that. To me, it's sort of like, if you take the US out of the picture, I think the vast majority of the world would have a similar conundrum with China. Meaning like, well, we're not going to do what China said. China's like, okay, see how that works for you. You know what I mean? Like, bottom line, two biggest economies in the world, biggest consumer base in the world. Good luck.
Yeah. Yeah. I mean,
good luck.
Us and China have the gold, so we make a lot of the rules. I mean, there's just no two ways about it.
Yep. But
it's just hard to figure out,
as it relates to stocks though. So I've been thinking about this a lot. I'm less sure on this one, but I do think that this is a scenario where I don't think they're just going to keep repatriating. And I don't think the reason they're going to keep repatriating is I don't think that they're financially illiterate. I think that they can look at financial history and realize that we always need to have a foot in the US. But I do think this is one of those events, I think at this point, that you can't really unsee. Meaning, I think you've made too many people conscious. I was reading another article today. The buy non-American flips back to buy American again. And I'm like, no, guys, it's just a rally. And I just really believe that because, you and I were more attuned to it. And we've been paying attention to the overvaluation of American markets for much longer than most have. But I will admit that as much as I knew that was in play, as we really started making or looking to make those changes early this year, even though I knew that these conditions exist, to actually compare the names and go, it was shocking. I didn't realize that there were those kind of values out there. Because we get so used to just looking at indexes, right? And you see Europe and some of these other ones, barely positive over the last 10 years. And you're like, well, that's because they're a BAS. It's so easy to write it off. Then you start doing comps. And that to me was what was really eye-opening. And I just, at this point, if you are repatriating assets, I think you are forced to some degree to look deeper fundamentally, because the next question you got to ask yourself is, where are we going to put them? Right? Some of it clearly is going into gold. But I think in that process of, because America was the place where, and it has been for quite some time, to be fair, where it was one of the only markets in the world you could just throw money at and not be worried about it, right? You can get bear markets and stuff like that. But, outside of 1929 to 1954, you've never had a period of multiple decades with negative real returns or negative, why am I blanking out right now? Nominal returns.
And speaking of, you just made me think of something. As investors, we had that run from, call it 82 to 2020, where if you're just long stocks and bonds, almost always one of the two is going to work, often both.
Yeah.
I think for foreign investors, they had the same setup, but with the dollar. So you had U.S. stocks and the dollar exposure. Usually one of them is going to work, sometimes both. So that's been another big flip this year, where like all of a sudden both weren't working. And it's very similar to 2020, that post 2020, where it was like, oh, that's what it feels like when both don't work. So
that's a dynamic I hadn't thought of.
Yeah.
Let me dig deeper in there. You're making my brain spin here. Well, no, I hadn't really thought about that. And let me go back and look at it
from that exact viewpoint.
Yeah, not from that exact viewpoint. We've talked around that, but let me I've got a chart of the DXY here, and I want to pull it up. Let's see how far it goes back. Yeah, it goes back plenty. So I'd say
the 2000 crash, you hit both.
Yeah. So
but the amount of foreign capital here was so much less.
Okay, going into July of 08, DXY is at 72.64. Okay, move it forward to the height of stuff when it started getting really crazy, September, right? Beginning of 09. You're at 85.86 on DXY. So you're looking at 12.
You've basically just gone up from then.
Yeah, well, and so if you own equities during the biggest crash in U.S. history next to the Great Depression, and you're a foreigner, basically speaking, and some did even better than this, but on average, while you were getting hit for 60% on the equity side of the portfolio, on an FX, the FX exchange was taking about 25% of that hit away. And then over, like you said, that was when it started taking off. So forget even equity exposure, but just on a currency basis, that crash, you were probably even money, because remember, S&P rallied really strong off that ultimate bottom that was
March of 09.
Yeah, March of 09. So on a currency adjusted basis, a lot of international investors were back to even money by the end of 09.
Right. And we always talk about the last 15 years. At this point, it's 16.
Yeah.
And through that, and that's where most of that, foreign flood of money has come in, is in that last 15, 16 years. And in that period, yeah, they haven't really had any double losses until now. So maybe that's enough for the repatriation. Now it's caused by the repatriation, but like so many things, complex systems, you get in that self-reinforcing dynamic where repatriations lead to lower dollar, and then lower dollar spooks foreign investors and they repatriate, and then it just feeds on itself.
Yeah.
So you could even argue that just having the kind of wild tariff levels for 2 months or whatever, a month, was enough to start that chain reaction. And then now it's feed on itself, and it's like, just kidding, we take the tariffs back. And then that loop is like, don't care.
Yeah.
So that's possible too. So I think watching the dollar moving forward, obviously equities, they have a lot of reasons to bounce. I mean, so does the dollar, like just from short-term oversold, a lot of people got washed out.
Yep.
Will jump
and
back
markets
in, all
don't
that.
move in straight lines.
Right. So I would think the dollar's going to bounce some here along the way, but watching the dollar, how much it can rally and how much it can't, is going to be super important to kind of gauge whether the rest of the world is still plowing on with Like, no, like I hear you, you're done with the tariffs, but just that's still like some money out.
Well, there's another thing to think about too, and I would expect the dollar going forward to be far less reactive to the upside during periods of duress. And the reason why is because, again, they've look at central banks' balance. They've diversified, right? Like it's not all a one way bet. And for the most part, you look at the last 15, 20 years, it was effectively a one way bet. When bad things happen, there was only one asset. You reach for the dollar. Well, the less dollar exposure you've got, by definition, the less need there is to reach for it.
And in this context, a lot of times the dollar is a euphemism for a bunch of treasury holdings as a reserve asset, which is already leaking, and our deficit, like just said, doesn't look like it's actually getting much better. So you could get also in a situation where, people go from like, oh, the deficit's going to go 3 to 5%, and the next thing you know, we have a slowdown, and it's 8, 9, and that further, creates that foreign exodus of, at least from the treasury side. So you could have that situation where market's bad usually equals like, oh, give me the dollar, give me some treasuries, and it turns into like, market's bad, now that's bad for treasuries, let me get out of that. And then you get in a situation where the dollar smile gets broken, like the one cheek of the dollar smile is broken, and you just have like a dollar weird angle, where when bad things happen, people don't rush to it, they actually rush out of it. All theoretical, who knows how this shakes out, but that's the kind of stuff to look for moving forward.
Well, here's another part of it too, right? Getting into the practitioner side of it, just speaking to some, now you got to see how long it persists and how long it plays out, but looking at it through the lens of an investor, there is nothing that gets you to change your perspective on an asset faster than when a hedge doesn't work, right? Meaning, you know what I'm saying? Like, and it leaves a scar, meaning it's happened to you and I before. You forever look at that thing with a more jaundiced view. You hedge around, it just changes the way you do things, especially if that hedge has been, like for 40 years, man, anything bad happens in the world, you just jump into US duration, right? It's simple.
Yep.
And you made good money on it. I remember COVID, you and I were both writing, if I remember correctly, really large treasury positions, right? From middle of January to the 1st of March, our treasury positions were up 30+%, right? And because we knew that, right? Now all this,
it was just a reaction, a mechanism. Like it's just automatic.
Yeah, 100%. You never even guessed it.
Turning the coffee pot on in the morning.
Yeah. We have used several hedges. We haven't really been hedged up a lot because our portfolio hasn't needed it this year. But any hedges we've touched hasn't been via duration, right? And it's because for the first time, I will say in my career, where I'm looking at a scenario going, depending on how this plays out, at least on the long end, I'm not sure it's going to come down.
Yeah, big time. Speaking of, we still haven't done the market rundown, and I want to do it because the 10-year was interesting today.
Let's do it.
S&P closed up 1.67, but at one point we were well over 3. And Scott basically came out and said, kind of poured cold water on any immediate like big slashing of tariffs on China. Clearly the president made it clear, hey, like we're going to chill out with the trade war on China. And the early returns just from the Wall Street Journal was like 50 to 65% is what they're talking about, maybe, but none of it's settled. Anyway, small caps up 1.5, equal weight up less than 1, which is kind of notable. Mag 7 up 3 and change. So really it was more of a Mag 7 jump. Ex-US equities only up 0.5%. So finally a day of some real give back there. Oil down 2%. Gold down about 3.4. Silver up a couple percent. Bitcoin was up a tiny bit. Dollar up 27.27 bips. So like that's not a great signal in this environment. How much it was up, I don't think. Decent day, decent like week for the dollar, but no big jump. And then same thing, a bond market. So the 2-year was up like 5-6 basis points, good bit. But the 10-year was down 1. Like you would have at one point today it was down big, and then it came all the way back to only being down 1 basis point. So like that continues to just freak me out.
So they're selling rallies and bonds. Huh?
Yeah, like
with this backdrop,
and it was down big. Like you're down like 8, 9, 10 basis points at one point this morning, and I saw that and I'm like, well, that makes sense. Like
yeah.
And then next thing I know, I look up and it's basically flat on the day. I'm like, man, like, and if I'm the administration, like, clearly they got somewhat spooked, and rightfully so, by the bond market. So to like kind of capitulate what you think is capitulating to the bond market, and you look over at it, and it's like, no, like that would be concerned.
Yeah, no, that is certainly concerning.
But maybe that goes back to the deficit thing, like where, well, if you're going to get rid of all the tariff income and you're going to do tax cuts and stuff, like, why am I going to rally?
Yeah, no, it's a compelling, and look, I did another interview on another podcast today, and they were asking me, how would you grade Trump's performance through all this, thus far in his presidency. And I gave a C- or D+ for implementation, meaning I gave an A for the aims of it, meaning I have incredible respect and admiration for his willingness to address things that have become third rails. I have immense respect for the way, right or wrong, he's willing to tackle or attempt to tackle so many of these things at the same time. On the implementation side of it, that was a head scratcher for me from the very beginning. You and I spoke about it. Now, listen, this is not me beating up on Trump at all. I have said all along, and I will continue to say this, that I think that this is a test that you can only judge once it's over, meaning where we end up. But, this is one of those things, because any talk of capitulation against China, I mean, it immediately erodes any leverage you thought you may have gained, right? I don't see how it's possible that it doesn't. The other thing, now I think it's greatly overstated the damage. We talked about that right out of the gate, the damage it's done to other allies. That being said, it hasn't made anything better with those people. You know what I mean? No. And so I will never understand the rollout. I don't think, in my opinion of looking at China, I don't think it was the right way to play chess against them. Not that they're going to outsmart you at every turn. From my limited understanding of the Chinese culture, I think you threw them a pitch that they were not going to swing at no matter where it was located.
Yeah, and that's why they haven't even met.
Right. No, and I get it, and that has kind of gelled with my understanding of the way I thought they would have responded. Right? Just culturally, I think they're put off by it.
Sure.
I think that there's a face saving aspect. I think Z is very sensitive to. I think one of the last things he wants to be seen as weaker than Trump. Anyway, yeah, the implementation of it, and you kind of had to know when we started running. I mean, we're at 145% on China.
It's hard. It went from like 30 to 50 to 100 to 200. I kind of lost count.
Yeah, because I thought we went over 200 at one point.
245, I think, is the last number I heard.
Yeah, but now I was hearing somebody say we're not going to stay at 150 anymore, and I'm like, I thought we were at 2. I don't know, and that's part of the problem. Look,
yeah,
and
it's not just us. Like, people in the White House have been themselves confused on where the number is.
Yeah, look, and that's a problem, right? Like, meaning, I don't think it's really hard for a listener to figure out what my thoughts are on Trump. But at the same time, I'm not going to sit back and just, rubber stamp every single thing he does.
Right. And flip side for me, I'm not a Trump guy at all.
But
I'm not going to
Trump guy, but yeah,
I hear you, but I'm not going to sit here and beat everything down. Like, and to that point, like, the guy's in the process of folding because he realized it was a mistake. And, when it comes to like the saving face thing, like, one of the dumbest things you can do is burn yourself down to save face, right?
Yeah.
And I give him credit for not doing that. Like,
yeah.
Like, people made him realize, like, hey, actually the consequences of this are severe, and you gotta make some moves to bring some of this back in, and instead of being like, no, like, I'm gonna play the tough guy. Like, he's like, all right, fine.
Yeah. Well, I mean, and that's one of the things I have always appreciated about Trump is there's I've always, one of my examples for this that I never understood was this foreign policy standard that we used to have. And it's one of the things that I'll actually give Obama some credit for, because I think he kind of changed, he started kind of a tide shift on this one. But people that we're at odds with, especially people that we're opponents with, especially on a military level, that we're not going to talk to them. I've never understood that.
Yeah.
Right. I mean, like talking to our adversaries is what effectively stopped the Cuban Missile Crisis. Right. Communication.
It just always makes sense to talk to. It doesn't matter if they're the craziest people in the world. Just talk.
Right.
Like, you don't have to do anything. You don't have to get, you don't have to agree to anything. But talk. Like, communication is good.
Every human being in the world is less likely to want to attack another human being if they have met them and shook their hand and looked them in the eye. Right. It's the way human beings work.
And something that's underrated that people that haven't worked deep in government, I don't think understand, is like the civil servants, mid-level people just carrying out important work in different countries that don't like each other. They often have great working relationships together, and they get very important things done together. So like they can just put politics aside, and then a lot of times politics will trickle down until like all the mid-level people like stop talking to them, and it's like it's actually really important work these people do together, and neither side's ideological. They're just trying to get the work done.
Yep.
That's always frustrated me.
But to try, like what I was going to say though, is his ability to backtrack in a way that you wouldn't think his personality would allow him to do it.
Yeah.
Okay, that's a bad idea. We'll switch. My whole thing with him, and the reason I gave him a C- D+ is I just wish that I think we went through some consternation, and I don't think we made our position any stronger against China. I'm not 100% sold that we've deep sixed it or we've killed it or anything, but I don't see any value add to the approach. I just wish it would have been handled differently going on the outset.
On that, I think that one of the biggest problems is, if you think about it, the single biggest lever we have on China is leveraging our consumption of their goods because it's worth $500 billion a year.
Yep.
So to take your biggest negotiating piece and go all in with it, you run that risk of them just being like, no, which is what happened, obviously.
It's like bringing your queen out too early in a chess match.
It's a perfect analogy. We brought the queen out day one, and they're just like, no. So now, as you have to backtrack, now we may find a way to make it look like we're both doing it, but we all know what just happened. Like, we're the ones that had to step down, and which is but again, I give him credit for that. But after you do that, then China, like, what is China's real motivation to get in there and give much when when we back down after less than a month of being tough? And if in this on the same slope, like if I'm Japan, Korea, Europe, India, anyone we're talking to, I'm looking at that and I'm going, oh, like, let's be patient. Like, let's not rush to get this thing done. Like, they don't want to deal with these tariffs. Like,
yeah.
And now, if you're Malaysia, obviously you don't have the same negotiating clout as China does. You can't play tough guy the same way, but you can understand that, like, going slow, not giving too much early may well pay off for you. And I think the whole world saw this and decided, like, hey, let's change our negotiating strategy a little bit. Like, I think we can get more.
Yeah. I don't. Well, and to be fair, I was saying it at the time where I'm like, look, I'll grade this on the outcome, but it just doesn't make a whole lot of sense. It kind of reminds me of anecdotal story here. 4th grade championship football game this year. So first of all, I think you and I can always pull a conversation back to a football analogy.
I for sure can. Yeah.
Yeah. And then I can take it a step further and make it about 4th grade football.
That I cannot do.
Yeah. So championship game. Okay. So we develop this off tackle power running play. And my son is one of our linebackers, and he is really fast and he's ridiculously strong for his age. He's just a horse. And probably the most powerful running back in the league. Just ran people over. Made me so proud, right? So we're looking at this defense, and we played them earlier in the year, and we developed this beautiful off pattern where I'm like, we're going to hammer them. We're going in just owning them, right? First play of the game, they get up there, line up in a defense we've never seen before. Our kids, it's 4th grade. Kids cannot adjust on the fly. They don't know their landmarks. They don't know who to block. We got beat 19-6, right? I think my son had like 10 rushing yards on the game because they were just keying on him the whole time, right? That kind of reminds me of that scenario, right? You go in, you go, okay, we've got this trump card, pardon the pun, that we're going to drop on them, and they switch the defense up, and you're like, well, and literally my entire game plan went up in smoke because everything was variations right off that. I was trying to move the defense, get him to do this, then we're going to hit him on the side, and I was sitting on the sideline scrambling, going, what do I do? You know, and I kind of felt like that. I was kind of feeling that sympathy from away where I'm like, you got to have a backup, man. Yeah. You got to have a backup plan. And then just culturally, which is odd to me because he's spent time over there. He's met Z face to face, right? I just, that was the other problem is I was like, I just don't see China responding to this, even if they have to, right? You're just culturally, they're not going to do it.
I was having a conversation this morning and like they locked down zero COVID for like 2 years. Like the thought they can't wait us out for a year or two on trade. Like, of course they can.
Well, and you have to look, and you have to also look at culturally what waiting out means to them.
Oh yeah. Whatever.
They've starved 40 million of their own people.
They've gone through some crazy stuff.
Yeah. And again, I'm not saying that it's the same country, but if you don't think it's
if our Wi-Fi is 2 bars in America, we're pretty upset.
Yeah. Well, it's sort of like inflation in Germany, right? Yeah. It was 100 years ago, the Weimar Republic. But if you don't think the residue of that or the scars are still, and not just present, but reflected in policy, right? And to think that when you're dealing with a culture that's as old as China, that for the sake of political expediency was willing to let 40 million people die of starvation, they're probably not a culture that's going to respond to something like that. That being said, I still think that we do have, I still think that we do have more leverage than we're given credit for, especially in the mainstream media and the way people discuss it. The other thing is, I don't think, we talk about Chinese culture. It's not one typically that lends itself to cutting off its nose to spite its face, right? It tends to be more utilitarian. You know what I mean?
They just look out for their own interests.
Yeah. And
they want to win. But I think a lot of people try to characterize them as not willing to give anything. I don't think it's true. Like, I think they can give in areas, but they're just not going to give on strategic imperatives. There's not.
Well,
but just like usually that's kind of how we negotiate too. It's like, well, here's some small stuff we're willing to give on, but like, here's some big things like we can't, and the scary part is we've bubbled up to where our strategic imperatives kind of overlap enough for this to be bigger than just like, you're selling us too much stuff, like please buy some more stuff.
Yeah. And I think the more and more I've thought about it and watched this unfold, the more I am led to believe that a better approach is what I think, a better approach with China would be one where you do things in such a way like cutting deals first or making inroads first with countries like 100%. Brazil, countries like India, right? Where you sit there and go, hey, we have got alternatives to you, right? They're going to figure that out real quick. And as we develop those alternatives will attract other countries as well, because the whole world realizes we had too much parked in China. And getting China to a point where you put them in a competitive stance, right? Where they're saying, okay, we want to compete for that business. What do we got to do to get you to keep it here? You know what I'm saying? Like I don't know what that would take, and I don't claim to be an expert, and I'm not saying that here's what you should have done. They're idiots for not doing that. I just think that would have been a much
the problem approach. Is I think that's what everyone else is doing. Like, so so Xi has not met with Trump since he took over. Xi has been all over Southeast Asia, pitching deals. Obviously Africa, the European Union's going there this summer to have serious talks. Some countries in Europe have already had very serious talks with Europe in big ways, or with China in big ways. You have, new deals potentially between Europe, India, so the rest of the world realize all right, we don't know what's coming out of the US right now. So we're going to go talk to each other. And a side effect of this that I think is important to keep an eye on, and something I've hated is this whole deglobalization is dead. And it's well, maybe for the US a little bit, but
it's not dead. It's right. Different.
If we pull back some on that actually creates a big incentive for the rest of the world to do more of it. So if you lose some access to the US or some access to cheap stuff from China or whatever, you're actually incentivized to lower tariffs for like the rest for other people in the world. So if you're Korea, it's bring down your tariffs against Japan, each other, like trade more, things like that. It actually, I would suggest like reduces friction for all non-US trade amongst each other. And you're seeing that with the talks and the deals that are getting done.
Well, it may not reduce friction, but it necessitizes a contingency plan.
Right.
Yeah. I mean, bottom line. I mean,
Canada's a perfect example. Like,
yeah, they don't have a choice.
Right. You better find some new partners in case the US follows through on some of this stuff.
Yeah.
And even if they do, even if the US backs down on all of it, you just realize how wildly dependent you are on one thing. You better go find the backup plan going back to the fourth grade coaching.
Yeah. Yeah. You got to have a backup
hope you don't
plan.
need it, but
yeah. Well, the other thing I learned from that is that, like that other team, I'm going to start scouting because they clearly that it's so I got to cover my coaching bona fides here. I don't want to. And
it sounds like you got Belichick. I don't know.
Well, we were in the championship game. I might remind you. No, it's
too soon to talk about championship games.
I know, man. I don't want. Oh yeah, you're still licking. I'm still licking my wounds from that one. A fourth grade championship game still got me apoplectic. 6 months later, something like that.
I'd be losing sleep over it.
Oh, dude,
that's why I probably should never coach.
I was like depressed for a week. I mean, not realistically, but I mean that was a tough pill to swallow. Hey, you know what, man? What a life, right? Where the big scars over the last 6 months are a lost championship fourth grade football game. What else? Yeah. Oh, the other one that we can't talk about is, I would really like to overplay this like most would that have podcasts or radio shows and use it as irrefutable proof of our ability to see into the future. But, but that is certainly not the case. However, I will say we've had a lot of these lately, pretty timely, prescient calls. But what you're seeing in gold right now, I think the reason you want to own it is still there. I think the reason you want to own the miners in a lot of ways is even more there than it was a year ago. But this is precisely why we were pulling back and taking profits on our gold positions over the last 5 days. You will get opportunities. And
sometimes things just get too expensive and too popular.
Yep.
It's that simple.
There's also an investment lesson in here that I really think everybody should learn. It's one that we both have learned and we talk about it all the time, which is straight up stock moves are really hard to stay away from. If you develop the discipline to stay away from straight up asset price moves, and doesn't mean you disavow them and ignore them, right? But if that ramp, those straight up candles, as we refer to it on the chart,
looks like it's about to turn left.
Yeah.
On the chart. Yeah.
Yeah. Listen, 9 times out of 10, you're better off not buying into it. Just, and do not let that 1 time out of 10 convince you it's wrong, right? Investing is like baseball, right? You don't need to hit every single pitch, right? If you hit 30% of them, now you need to hit more in the investment world than that. But like baseball, if investing, you get 50 to 65 and you size them correctly, you're going to crush it.
You can become a bajillionaire with a 40% hit rate.
Yes.
If you know what you're doing in investing. Yeah.
Yeah.
If the risk reward's right. Yep. Then the batting average can be low.
Yeah. Well, Mark Spitznagel comes to mind, right?
Yeah. I mean, people say Druck is about 50%.
Yeah.
But if you think about it, if you take a 3-to-1 risk reward on every trade you do and you hit 40%, you crushed it.
Yep.
And it's that simple.
Yep.
It's not that easy, but it's that simple.
Yeah. Well, it's harder finding the 3-to-1 investment, identifying those plays that can,
and honoring your stop every time and all that stuff. Yeah.
Right. And then, and then knowing when to reload as opposed to getting out and all those kinds of things, which is tough. That's where the art of it comes in. But we have lived in an environment where with so many different assets, Bitcoin, different stocks, different tech things, where people were rewarded for buying that candle. I really think that I really think that has changed. I think that that's going to be different going forward. And I think that I think that everybody listening would be best to just take that to heart. Don't buy things that are going parabolic.
Yeah, and that's exactly when. And this is a perfect case study when Wall Street starts hyping it, when the financial media, all of a sudden, every third headline's about it. Every second post on social media is about it. That's the way gold got. You got this fever pitch. The Google trends of people looking up GLD explodes higher. Like there were so many like sentiment positioning signs that just like clustered all of a sudden within a week, and it was like, oh, okay, well, we're about to get it. And
I started getting random text messages about gold, emails about gold. And I'm sitting there going, and it's so funny to me, man. And again, it's not fun. I get it, but doing it professionally, you look at it differently. There's no guaranteed ways to win in this, but you want to buy things when no one's talking about them, right? It's when people, it was like us.
That's when we got into gold miners.
Yeah, that's when 100%. We got into, I remember how many people talk. I took a ton of flack on Twitter over the gold miner thing. Oh, it's never going to work. We talked a lot about it on the dots. That being said, the minute we saw it going up 2-3% in a day, we're like, this is too. And everybody's like, you got to be excited. You got it right. And I'm like, no. I'm excited when gold's going up 25 to 35 bips a day, just consistently. Yeah. That's what I like to see.
I was on the side of the boat no one was on. Now everyone's over here and I hate it.
Yeah. Now I'm climbing the mast because I don't want to be on the other side. I'm trying to position myself in the middle of the boat. Right. And it's also especially true in any type of commodity related stock. Don't ever buy a rip. Be patient. You'll get a chance to buy it cheaper.
Yep.
And also remember, guys, you're not going to hear this on you're not going to hear this on Kramer. You're not going to hear this on a lot of these places. But it's an age-old adage that will never not be true with investing. The one factor that has by far the single largest definer of your success in any investment is the price you paid. Nothing matters as much, right? It will define how much you lose. It will define how much you gain, everything. And for that, you got to be patient. And I think what's really tough about that is we've been in a market for a long time that's worked not that way, right? Buy Bitcoin, buy everything that's going parabolic. The more parabolic it's going, the better it is. And those are not, if you think that's the way markets work, it's not. Those are aberrations. They are bugs. They are not features, right?
Yep.
And the quicker you can learn that, you will save yourself a lot of brain damage. And you will save yourself some serious psychological scars.
No doubt.
And I also think you're going to get a shot here with gold. Nothing about that chart or anything like that gets me too excited to jump in there. We're going to hold our core positions. But that's the other advantage of being patient and being very selective of how you buy. When you've got really good price. Look, nobody likes to see their accounts go down. But there are, and we've got some of these where you've bought them at such low prices. You're like, no. We'll sit here and take. There's no way in the world I'm trying to get too cute with this thing, right? And that's the way you want to own things.
100%.
And yeah, so hopefully people are learning that lesson. You got anything else for us?
Nope. Light data today and really for the rest of the week. So,
all righty. Well, it's going to be interesting.
Indeed.
All right, guys. Well, as always, this one will be broadcast on video as well on YouTube. You can find us at Know Your Risk Podcast. Not tough. You can also get us at knowyourriskradio.com. We're on Instagram now. Still on Twitter, TikTok, all kinds of stuff. We've come into the social media technological age. And so if you want to see our faces while we're talking, not a lot of people do, but maybe you're that odd person, doesn't have great vision, but like, oh, those are striking young men. First of all, we're not that young. But anyway,
to say young, I'll take it.
Yeah. Hey, it's a self declaring myself young, right? It's the advantage of being in this business. So a lot of your clients are a lot older than you are and makes you feel young.
Good way to stay young. Yeah.
Yeah. Young on a relative basis. So anyway, until tomorrow, guys, we will be back. Have a wonderful evening. We'll see you tomorrow. You're listening to Know Your Risk Podcast. Download and subscribe at knowyourriskradio.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.